Okay, so the poll results show 62% of us are somewhat prepared for the upcoming legislation changes in finance and HR in 2025, which is good to hear. Hopefully we'll be able to fill in some gaps for you as well, to make you fully prepared. But Andrew, over to you.
Morning. So hello and welcome to It's a Matter of Fact. This is a webinar that we run annually, and usually just after the spring budget. However, after the significance of the changes announced in the autumn budget back in October, we thought that there'd be a lot more value running this just as we kick off into the new calendar year. So what do we look to do with this session? First thing we look to do is we break down the key elements of the budget and try and give some sort of clear understanding of the impacts on SMEs, and then update you on some of the regulatory changes affecting SMEs with some up-to-date information on compliance requirements. What it allows business owners to do and leaders is just take a short amount of time out of the busy days and just consider how some of these things might affect their businesses. Unfortunately, due to the nature that there's quite a bit of statutory update data in this presentation, but we are told that it really does present a useful and concise update on the key matters. Just a few points, and Andrew sort of touched on most of these. Obviously, keep your microphones off. It is being recorded. We will be pushing this out through our social handles. Try and have a bit of interactivity, mainly through 3 or 4 polls, just to get a bit of a feeling on where the audience is at. And if you've got any questions, you can drop them into the chat tab. We will try and answer them all at the end of the presentation. So by way of intros, I'm Andrew Jackson. I'm a partner at Fact3, work in the numbers division. I'm an accountant. I qualified over 25 years ago, and I've been with Fact3 for 24 years, so back since 2001. We've also got Laura Brogden, who works at the numbers division, who's also a partner in the business. She's been qualified for over 20 years and been with the business since 2006. We've got Jane Simpson from the people division, another member, partner in the business. Jane's been with us since 2016 and is a member of the Chartered Institute of Personnel and Development. And from the systems division, we've got Andrew Doyle. Andrew's been with us since 2021 when his own business, Sasage, which is or was a Northwest-based MSP, merged into Fact3. That had been set up since 2011. If any of you don't know what we do at Fact3, we support SMEs with their accounting, HR and IT needs, or we call it numbers, people and systems. We've been doing this for 25 years now, and we work with nearly 200 businesses across the UK of various industries and sizes, with collaborative resourcing that we call core sourcing. If you want to find a bit more about what we do, head to fact3.co.uk. There's a really good explainer video on the homepage. It's maybe about 3 minutes long. That'll just give you a good understanding of how we can support you with your departmental needs on what can be a full-time or a fractional basis.
Absolutely. And the key message of this webinar is if you hear anything that kind of sparks a little bit of interest for you, or maybe even a little bit of panic that you might not be prepared for this upcoming legislation, we're always here to help. We do solve these issues for our clients, and we are doing currently. But if you find that you need a little bit more help, please do get in touch with us.
So the agenda, we sort of break into the numbers, people and systems. From the numbers point of view, we just have a quick view on the current landscape in the UK, so the economic climate. We'll then get into some of the key messages from the autumn budget. Jane will then pick up from an HR perspective with a recap on prevention of sexual harassment and some changes from 2024. Some upcoming employment law changes that will affect your business and some statutory rates, just a reminder on where we're at with things like living wage, etc. Andrew will then pick up on the systems side of things, looking at productivity for your team, a bit of a discussion around AI, and then we'll wrap that up with a bit of a summary and look at any questions that come through. So on the numbers side, firstly, the climate. So after the back end of 23, we entered what was classed as a shallow recession. We saw some growth in the first half of 24, but this was followed by a flat line in Q3. It is expected that 24 will report growth annually, probably around 1% when the numbers are announced. And the outlook for 2025 from the Bank of England is that we'll see further growth in 2025 of around 1.5%. I personally think the last 12 months has been a little less volatile on the whole for SMEs than what we saw in the previous year. We've certainly seen some settling in the labour market, inflation, energy costs aren't quite as volatile. But I think, I still believe, and I think many others do, there is still a bit of instability and nervousness around where the economy's heading. I think you're kind of getting that message, I think, at the minute from the news channels. The FX markets, the foreign exchange, the pound's weakened since September. So it's gone from 134 down to 122, which might not sound that extreme, but it's a 9% movement. And if you're a business that's bringing in product from China or India, where the currency trades the dollar, that 9% can be quite significant and means higher prices for your business. Here we've listed some of the sort of key economic factors at present. Obviously, we saw the change in government in the summer. It's been a bit of a rocky start for old Keir Starmer, hasn't it? And we had a pretty controversial autumn budget in October from the new Chancellor. Inflation, just a reminder on inflation, this is a measure of how quickly prices rise or have risen over the last 12 months. The current rate's at 2.6% for the 12 months to November. We'll get the next readout in this week, actually, on Wednesday. But I don't think any major movements are anticipated. And you'll see the Bank of England base rate, so the interest rate is currently at 4.75%. This is just a really simple chart, really, that I think is quite useful. It shows where the last 2 years have gone in terms of inflation and interest rates. So inflation-wise, you can see there that we've had quite a big movement. So if you look at sort of Jan, Feb, March, so quarter one of 2023, we was up at 10%, and we're down to 2.6 currently. The latest forecasts are that 2025 we should see inflation at around 2.5%, but we are yet to see some of the impacts of the budget changes that are coming in April, specifically the employers' national insurance and increases to minimum pay that we're going to discuss. Interest rate, if you could just go back, Andrew, sorry. Interest rate wise, we have low interest rates in the UK for many years. So following the economic crash back in 2008, it's been obviously great for borrowers, but not so good for savers. We've seen the base rate rise quite gradually over a period of time, up to 5.25% back in August 2023 to combat the inflation. And it stayed there for 12 months. We've seen a bit of a drop over the last few months, so we're down to 4.75% at the minute, and businesses have felt the impact of that. We've certainly seen it with some of our clients, that higher interest rates has an impact on businesses that operate invoice financing or overdraft facilities. Lots of businesses have got properties and they've come to refinance and found that those favourable rates that they've had in the past are now not there. It means higher debt repayments. Taking on new asset finance and other debt streams are obviously more expensive. And of course, that's the same for the consumers. Household mortgages have gone up, credit card debt at low rates has now started to increase, and all of that has put a squeeze on cost of living continually over the last year or two. Bank of England, they say they're going to keep the rates high enough for long enough until inflation gets down to 2%, which is where they want it. And expectations are that interest rates will settle somewhere around 3.5 to 3.75% by the end of 25. Unemployment, you'll see on the previous slide, we're at 4.3% in the UK for over 16s, slightly up on where we were last year. It was about 4% in Q1 last year. Forecasts are that it'll come down to about 4.1 this year, but again, there's probably a little bit of nervousness in the labour market of what the changes that are coming through with NI and living wages could mean, and that could have an effect on that. So the budget. So the budget was the back end of October. Some of the key outputs from that. Well, the first thing is just to recognise the level of national debt that we've got in the country. So it's currently at 2.8 trillion. If you don't know what a trillion is, it's 1,000 billion. So quite a lot of money, and it's up from 2.7 trillion the previous year. So as a country, our national debt is continuing to rise, and the Chancellor used the first budget to announce that we're looking at a significant increase in public spending. And of course, this has got to be financed, and where it will come from is a combination of tax rises and higher borrowing. The biggest and most controversial change that was announced is around employees' national insurance. So employees' national insurance is the Treasury's second largest source of tax revenue after income tax. And it's really important for businesses to understand the additional costs that these changes mean and factor into the budget processes. So what is happening with national insurance? The first thing is the rate at which businesses pay employees' national insurance is increasing from 13.8 to 15%. So it's a 1.2% increase. The second impact is that previously, so with effect of 6th of April, anybody who is employed in your business, once they start to earn over £5,000, you will start to pay employees' national insurance at that 15% rate. And that was previously 9,100. So you're starting to pay NI earlier on employees' wages. A benefit that has come as part of the budget is that we have a thing called employment allowance, employees allowance. So most businesses who don't pay over £100,000 of national insurance claim an employer's allowance, which amounts to £5,000 per annum. It's claimed through payroll. What they've done is increase that allowance to businesses to 10,500, but they've also taken away the cap. So businesses that pay NI over 100,000 who didn't get any employer's allowance will now be able to claim it, and the amount is 10,500. So what does this mean? So with effects of 6th of April 2025, every employee earning over 9,100, it will cost an extra £615 to the business in additional employers' NI. And for every employee, you'll also pay an extra 1.2% of employers' NI on their earnings over that amount. So a few examples on salary bands. If you had maybe a part-time employee earning £10,000 a year, that is an extra cost of £626 a year. At £20,000, 746, 30,000, 866, 40,000, 986. If you've got somebody earning £50,000, it is going to cost you an extra £1,106 a year in employers' national insurance. As I've just said, the employment allowance, if you are currently claiming this amount, you're going to get an extra 5,500. If you're not currently claiming it, you're going to be able to claim 10,500. So as an example, if you're an SME with 50 staff and there's an average earning of 40,000 a year, and you're currently claiming the employment allowance of 5,000, you are going to be liable for an extra £49,300 in NI extra. Now, you'll get the extra 5,500, so the net cost to your business would be 43,800. It's obviously quite a significant amount for businesses, and decisions will need to be made for many businesses. I just don't think everybody can just swallow that additional cost, but we'll discuss what actions businesses might take at the end of the presentation.
Now we're going to our second poll. So if everybody could please participate in this, have you calculated the additional cost impact of the NI changes to your organisation? So we've got 23, 25 responses, just over a quarter say no, 3/4 say yes, so that's quite good. Okay, Andrew?
Yeah, over to Laura, just to pick up on some of the other budget changes.
Yeah, sorry, hi. So we'll start with personal tax. As we mentioned at the beginning of this webinar, it does get a little bit dry in spots, and this is perhaps one of the driest. So just please bear with me. And also, as we said, it is being recorded. You will have access later, so don't feel you need to make any furious notes at any point. So in terms of personal tax, it's a story of no change, because the personal tax bands were fixed back in 2020 and they've been frozen now until 2028, and all the tax rates remain the same as well. So just a quick run through of what they are and where we are at the moment. So the personal tax allowance remains static at £12,570. So that means anybody earning up to that amount, you're not paying any tax on that first lump of cash. After that, the basic rate of tax kicks in at 20%, and that's for earnings on the next 37,700, which means you can basically earn just over £50,000 before you become a higher rate taxpayer. Once you breach that threshold, the higher rate tax is at 40%. And then for anybody going above 125,140, you then move up into the higher earner bracket, paying tax at 45%. This is a rate actually that did move. So despite freezing all the tax bands, they did actually bring down the higher rate limit from £150,000 in 2023, which again is less favourable for those taxpayers. There's also a higher rate bracket that catches people out who are lucky enough to earn above 100,000, and this is where you lose your personal tax allowance. So once you go beyond that £100,000 earning threshold, you'll lose £1 of your personal allowance for every £2 of income, which gives you an effective rate of tax at 60%. And the rebates remain frozen until the 6th of April, and what that means I'll go into on the next slide. So the rates and tax bands were frozen back in 2021 as a consequence of the pandemic, and it's a way of the government of increasing their tax revenues without increasing the headline tax bands, because as everybody's salaries naturally increase with inflation and pay increases through it from your companies, and the rate at which you pay tax remains static. So there's just a quick little visual here in what that means in real terms. So for somebody earning £75,000 as in this example, your inflation adjusted tax-free amount should have increased to £15,483 if we'd followed inflation. So the impact of this is it's pushing more people into the higher tax brackets and into the tax system itself. In this example, on an earner at £75,000, you'd now be paying £3,000 more than you would if the rates were adjusted in line with inflation. The wider consequence is expected that by the end of the freeze in 2028, they will have brought another 4 million people into paying tax. 3 million people would move up into the higher tax brackets, and 400,000 people would be subject to the additional rate. As well as the tax brackets and rates not moving, other allowances have also remained static. So things to be mindful of here is if anybody's claiming things like child tax benefits, those brackets haven't moved, so just take care to be mindful of when you might breach those brackets and have to stop claiming or repay any child tax benefit. There's also losses to things like tax-free savings. So the recommendation is if that affects you, if you're lucky enough to have some savings, might be a time to move them into a tax-advantaged ISA. There's also ways and means of moving money and paying more into your pension in order to make use of your tax-free advantages there. But any questions about anything like this, I know it's quite complex, so just reach out and contact one of the numbers. Tim will be happy to help. Moving on, this is more in the personal tax field. So this is the capital gains tax. This was expected to be a target of the Labour government, that they would increase this. So no surprises here when this jumped up. So the rate increases unusually applied immediately once the budget numbers were announced. So there was no delay till April. These kicked in straight away in October. And this stopped anybody from making any pre-planning after the announcement. So the rates now are at 18% for basic rate taxpayers and 24% for higher rate taxpayers. Those were previously at 10 and 20%. So this tax applies to if you're selling any assets, such as additional properties outside of your main residence, any shares, any other assets. And there is currently a tax-free allowance of £3,000, which applies per tax year. So there is a small opportunity to plan here, although it is very slim margins. In terms of anybody who's a business owner and are planning to exit their business at some point, just bump onto the next slide, please. There is a relief available known as Business Asset Disposal Relief. This was formerly known as the Entrepreneurs Relief. So what this means is it's an encouragement for business owners so that you build up your business and on exit, you're not paying the headline rate of capital gains tax. It was widely feared that the Labour government might scrap this altogether. I'm sure a lot of business owners breathed a sigh of relief when it wasn't scrapped, although the rates again are less favourable than they were previously. So the current rate here is 10%, which is quite favourable compared to the headline capital gains tax of 24%. But this will be increasing from the 6th of April to 14%. And then it'll jump up by another 2 percentage points in April 2026. There is a lifetime limit here. Previously, that was £10 million. That's reduced quite dramatically now to just £1 million over a lifetime. So that's kind of tethers any serial entrepreneurs there. There are restrictions in order to make a claim. There's a minimum requirement of an ownership of 5% equity and voting rights. That needs to be held for a period of 2 years, and some other restrictions, which again, we can, if anybody needs assistance in looking at those, we could, come and talk to us. Likewise, moving on now to corporation tax. Again, this does remain unchanged, which allows us some stability in the country then, and ability to plan ahead. Our rate remains the same, as I've said. So for low profit making companies, anything below £50,000, you'd be paying corporation tax at a rate of 19%. If you go above profits of 250,000, you go into a 25% tax bracket. And there's a tapered rate that sits in between those two profit levels. I mean, when we did bump up previously, our corporation tax rate was at 20%, and there was a bit of noise that we, as a country, are uncompetitive. But when you compare our rates to other countries in the G20, we remain at the bottom end of the table. So there's far less favourable rates out there. Ways that you can reduce your tax bill, which I'm sure everybody would be interested in. So we do still continue to have investment allowances, and this applies when you buy some capital items, so not day-to-day expense of the business, but larger assets, mostly referred to as plant and machinery. I think most people will be more familiar with that term. The rates that you can make a saving depend on your headline rate of corporation tax, but you can claim up to 100% of the cost back from your profits before tax in the year of the purchase. You can claim up to £1 million of purchase. That's a combined purchase, not just one item. There are some restrictions on some items, such as cars. They don't apply. But there are something called special pool items where you can claim not the full 100%, but you can claim 50%. It's quite complex and there's a lot of variables in there. But again, it's something that we'd be happy to help with if this applied to anybody on this webinar.
Okay, we come on to our third poll now. So does anyone claim or intend to claim R&D tax relief? If you could submit your answer now, please. Okay, so about a quarter of people considering it.
Yes, I think 50% are not, but 50% either are claiming or considering making a claim, which is interesting, and that sort of sits with our client base really. So it's not really a surprise that there's a large quantity there. So in terms of the reliefs themselves, now that we know everybody's still with us and awake after those numbers. So the headline rates for the new tax year do not change. A couple of years ago, there was quite a bit of upheaval within the R&D tax relief schemes arena. Much of this was led by a bit of abuse of the system. So there's been some work in order to clamp down a bit on those erroneous claims, and also try and make the hurdles more towards real knowledge intensive businesses, so that they're targeting the companies that are really invested quite intensely in real research and development. So the rates remain the same, sorry, but the calculation is a little bit different. So for loss-making SMEs, the majority, I won't say all because there are some caveats in there, but for the majority, if you're loss-making, you should be able to qualify for the enhanced R&D intensive support. This will give you access to a repayable tax credit, which is very valuable, of course, especially to early stage businesses. Under this scheme, you're allowed to enhance your expenditure level by 86% to offset the tax, and your repayable tax credit can be up to 14% dependent upon meeting certain intensity conditions. For those who don't qualify for the intensive scheme or are profitable, then there's still access available to what is now known as the merge scheme, previously known as the RDEC scheme. It's much of the same, and the rate here is a saving of 20% from expenditure from your tax bill. So again, even though it's not a repayable credit, it is still quite valuable. Under both schemes, there are some extra little things ticking on over there under the bonnet. So there's been some changes to the rules around externally provided workers. HMRC have provided some more clarification about what and what doesn't qualify, what the rates are. And also there's now an exclusion on activities carried out overseas, which could potentially lead to some decisions being made over in the UK. There is a cap now in place in relation to your company's PAYE payments. HMRC are now also requiring additional information requests to be submitted before you make a claim. So they're catching this details about your activity quite early on in the process. And we are seeing increased scrutiny by HMRC. So I've spoke to several tax advisors, and from our own client base, I think we've got nigh on 100% being queried or questioned. So it's just something to be mindful of, that there may likely be questions coming back your way. So just be prepared. So that was, I know it was a bit stats and numbers heavy, and there was a lot of information there, and I've just, sort of scratched the surface, but hopefully that'll give everybody a bit of an understanding of the lay of the landscape. I'm happy to have discussions with anybody who perhaps like a deeper dive into certain areas. But now I'll hand you over to Jane to talk about all things people.
Good morning. Yeah, unfortunately, there's an awful lot of change in the numbers space, but there's considerable change in the people space as well. We've seen quite a lot of this come through already, but this year is set to be full of change again. So what I wanted to do was just have a look at the latest big piece of legislation that has come through, which is the prevention of sexual harassment. And the reason for me doing this is because quite a lot of businesses, this change came in the end of October last year. Just looking at our own clients, that they're still in catch-up mode on this. So it's just useful just to provide a little recap. We've shortened this to POSH, because to be honest, we're sick of saying it. But essentially, what we've got is a law change at the end of October. What this did was it imposed a duty on businesses to be proactive. A preventative duty has been imposed, and that's to prevent sexual harassment in the workplace happening, rather than the reactive state that we were in, which is very likely that policies are in place, but businesses tend to react to a complaint coming in. This actually reverses that and puts a duty on businesses to prevent that complaint coming in. It also puts extra emphasis on people being able to report these things without fear of detriment. So it affects every single business, whether you employ 1 or 1 million people. And what it means in practice is that businesses have to demonstrate that they've tried to anticipate scenarios and take reasonable steps to reduce the risk of sexual harassment in the workplace. This has been coming in for a couple of years. We've seen various versions of strength of this legislation. There was some watering down of it, and that watering down does refer to this sort of third party piece. Currently, it does cover third parties in terms of you risk assessing the roles within your business and their interaction with third parties. You're not necessarily liable for third party harassment, but you do need to consider that you've taken some reasonable steps. If somebody, for example, spends an awful lot of time with customers or with suppliers, that does need to be factored in. The cost of getting it wrong, if you can't demonstrate that you've taken these preventative steps, and there is a tribunal or a complaint, then the employee can report to the external body, which is the Equality and Human Rights Commission. An employment tribunal judges are able to uplift any compensation by 25%. The compensation is currently unlimited anyway. So there's just an extra financial sort of slap on the wrist there for not carrying out the preventative steps. So you will know if you are POSH ready, because you will have already carried out a risk assessment. You'll have anticipated scenarios. You'll likely have identified high risk areas versus areas where you feel that you've got suitable controls already in place. And those risk assessments will have considered your employees' jobs when it comes to third party interaction. You'll have identified the risks. Hopefully you'll have put them in a category of high, medium and low, and appropriate actions to remedy or reduce the risk should have started to take place. It will definitely have included the introduction of a prevention of sexual harassment policy that is wider than your previous sort of bullying and harassment policies that you may already have in place. The definition of sexual harassment has widened, so that new policy should cover that. It'll make clear the real clear sort of reporting channels. It'll need to make them really visible to your team. And really importantly, the guide mentions that training has to be given to employees and managers, and it specifically says that goes beyond the issue of a policy. So this is training that is meaningful, and that we can demonstrate has been not just the issue of a policy and signed to make sure that you understand we've got one. It's in-depth knowledge, particularly for managers, on how to handle these scenarios. People have got to be encouraged to speak up. And if we do get any reports in, we've got to take them seriously. We have definitely seen a surge, whether it's timed with December and lots more social events happening, but we have definitely seen a surge in this. And what you see with these things is when awareness in the climate increases, you do tend to get more individuals coming forward that may not have done previously to speak up about situations that they've experienced. If you haven't taken any action yet, I would definitely reach out to us. If you are a current client, we've covered you in this. We've got policies that have been issued. We've been running some training workshops, and we've provided a bit of a risk assessment template for businesses to use as well. So you are somewhat covered. But certainly, if we've got people on this call that haven't got their business POSH ready, the financial impacts are quite significant.
So just on that. Oh, go on, Jane.
No, that's okay. You go, poor man.
Just on that, then we've come to our next poll. Are you POSH ready? If you can submit your answers now, please.
Okay.
10% say not at all. Dun, dun, dun.
Yeah, the partly one is interesting, because we'll get onto it, but the first draft of legislation said all reasonable steps need to be taken. So we were all waiting for a bit of a checklist of what is all reasonable steps. That's the watering down. They removed it all, and it's just reasonable steps. So you're not expected to be doing everything. It's just about doing the right things for your business. But unfortunately, that's not the end of it. The new Labour government, when they were appointed, were quite frustrated with the reversing or the watering down of POSH by the previous government. And they've made a firm commitment. They've not timed it, but they've made a firm commitment that it's not going to end there. The previous watering down will be reversed at some point. So what we can expect there is that this reasonable steps will become all reasonable steps. And also the liability around third-party harassment will be made into the employer's obligation, the employer's liability. That's an absolute minefield, and it's why it was removed in the first place. So we're going to need to watch this space on how that can all impact people practically. It is just worth just bringing you up to date on some of the changes that happened last year. It was a busy year last year, the Labour government coming in, an awful lot of financial changes, and I think that took the focus. So just as a bit of a where are we at right now, it's worth just mentioning that TUPE consultation changed early last year. TUPE is when we transfer employees either into your business or out of your business because either your business has sold, part of it is sold, or you've outsourced or insourced a service and that work has moved. This is good news. The government reduced the consultation around that. So what they said was that businesses that employ less than 50 employees, or where the transferring employees is less than 10 people, we don't need to start to elect representatives, consult with those representatives. We can go to the person direct and speak to them direct about it. So that was a good, positive move for small businesses. The next one was paternity leave. We've got an allowance of 2 weeks worth of paternity leave for people that are either adopting or having babies. Previously, that had to be taken as a 2-week block together within the first 8 weeks of the adoption or the birth. Now, those weeks can be taken separately and any time within the first year of adoption or birth. there was an awful lot of clarification last year as well around how we accrue and how we pay holiday pay for irregular hours workers. It really made clear what is an irregular hours worker. So we've got clarity now over how we should be organising and paying holiday pay. So that was very, very helpful. It also reintroduced the ability to roll up holiday pay, which had been banned over a decade before. So that is where we cut through all the accrual and the payment, and actually every week an employee receives an amount of money which is classed as their holiday pay, and then when they take time off work it's unpaid. So from an admin point of view it's actually really, really helpful. So that was reintroduced as a method as well last year. Also in April we have the usual increases to statutory payments, national minimum and living wages going up, and the tribunals uplifted all of their awards. A few days later we had an introduction for carers to take 1 week of unpaid carers leave per year up to 12 years. We also had those people of maternity and adoption and shared parental leave, enhanced protection around redundancy, so that they have the right to be offered the suitable alternative roles as a priority over other employees when at risk of redundancy for a whole 18 months after the baby has been born or child has been adopted. And we also saw flexible working be given as a day one right. Also that people can have 2 applications a year rather than the previous 1. Consultation when we're talking about alternatives, and rather than a 3-month processing time, a 2-month processing time. So lots of change there for families. We had in September workers that are on unpredictable term contracts, very, very flexible and fluid contracts. We have the right for them to request more predictability around their working patterns. There is an opportunity for businesses to reject that request, but nevertheless, there is a process to follow now if somebody puts in writing that they want more predictability around their working patterns. We've covered off POSH, which came in October, but the other thing that also came in just in time for the busy period in hospitality was the duty to give tips to workers. So from October, 100% of tips must be given to workers by the end of the month, by the end of the following month that the tips were given. Businesses that run tips have got to have a written policy, and they've got to keep 3 years record keeping for in the event of questions, queries and complaints. So that's the look back. As we look forward, what's coming up? Well, what we've got, can you pass on? I think just as a reminder where all that has come from and where this will continue to go is the Employment Rights Bill, which was 2024. Labour government in June 2024 labelled this as we're going to make work pay. Three big areas here: protect workers from harassment. We've already seen that come in, and we're going to expect a second wave of that. Strengthen family leave and regulate 0 hours contracts. One of the big changes coming up this year, it happens every year, but it's just worth having a glance over at the statutory rates. These are quite, if you look at the increasing amounts there for national living wage at the various age brackets, you can see quite significant increases, particularly aged 18 to 20. But in all, you know, the lowest is 6.7% increase. That's significantly higher than the inflation that Andrew was discussing earlier of 2.6%. So what we're going to see here is more particularly in the younger age brackets, we're going to see this gap reducing in terms of seniority and experience. In terms of, we're going to see a gap of pay reducing, and it may be worth you having a look at, if you implanted that into your current workforce, what potential problems and disputes might that generate for you. Family Friendly also has the usual increases in April, a much more palatable increase there for those sort of statutory payments such as maternity pay, paternity pay, parental pay, adoption, and the statutory parental bereavement pay as well. So just going back to the Employment Rights Bill and what's specific. So how do those three intentions play out this year? All of these are dates to be agreed, if you like, but we are told that they are expected to land with us in the next 12 months. The first one is the 20th of January. This gives tribunals extra clout, if you like, to increase protective awards by 25%. Protective awards are given when we collectively consult with our people in cases of redundancy or restructure, and the protective award is given when businesses don't properly consult. That's usually 90 days gross pay that's awarded, and tribunals are looking to uplift that by 25% for businesses that don't comply with the code of practice. There'll also be some changes on fire and rehire. And again, we see businesses using this method when they are looking to change some significant changes to terms and conditions. Usually the case when there's a change in terms, it might be reducing working hours, reducing pay, stripping away bonuses, taking away a perk or a benefit. When we are changing terms and conditions, sometimes businesses use, if they can't gain agreement informally, they use a fire and rehire, which is the contract that you're currently on, we will terminate, but what we will do is rehire you on brand new terms. There will be a brand new code of conduct that will replace the old one on this, which will be more stringent for businesses to follow, making it more difficult for people to be fired and rehired. Statutory sick pay, the removal of the waiting days and the SSP being paid from day one takes us back to COVID days when we got rid of waiting days. They returned, but they're soon to be off the agenda. And also the removal of the lower earnings limit. Some people don't receive SSP because their earnings don't reach the certain threshold, which is around £120 a week. That's going to be removed, meaning that SSP will be paid to more people and it'll be from day one. We know that the Labour government do not like 0 hours contracts. So these will be banned in terms of the exploitive 0 hours contracts in favour of a more guaranteed hours based contract. This will be based on guaranteed hours that the business has to provide the employee on an average of over 12 weeks. There'll also be penalties for compensation for employees where shifts are cancelled, shortened or changed at last minute. Unfair dismissal will impact significantly. There is a proposal that people will gain the right to bring employment tribunal claims from day one of employment rather than the current position, which is 2 years service. This will remove all the flexibility that businesses currently have on exiting people and using shortened procedures. They are talking about combining this, however, with recognising probationary periods more formally in law. The current lobbyists are saying that they're trying to get that up to a 9-month time frame. Dismissals during probation can be therefore shortened, simplified, and a light touch approach can be applied, and any compensation will be lowered. So it won't be the current unfair dismissal sort of bracket. It will be a much more lowered financial impact. Nevertheless, this is going to focus businesses on having really stringent probationary period assessments in the first 9 months of people being with them. They will be able to use a shortened process, a much more light process. It will need to be clearly defined, but the flexibility that businesses currently have on exit we will see a departure of. Dismissing women who are pregnant or who are on maternity leave will be completely prohibited within the 6 months during their pregnancy or their maternity leave and during 6 months of their return. There will be some very limited exceptions, and I'm guessing that will be around genuine redundancy reasons. There'll be some other day one rights introduced. There's a current right for bereavement leave for parents in the death of a child. This will be extended to cover other relationships. And the plans are to make flexible working requests agreed by default unless the business can prove that they are unreasonable. So it shifts the burden a little bit more. Beyond next year and further out into the field, probably into 2026, 2027, just to give you an idea of where the government's mind is, they are considering a legal right to switch off and disconnect outside of working hours. That brings us in line with the Republic of Ireland. They are also looking at removing the current tiers of employment, if you like. So at the moment, we have self-employed, employed, and we have this middle bracket of worker. They're looking at creating a single status, meaning that everybody gets the same rights irrespective of the way in which you're engaged. There'll be review of equality, so it'll look at race and disability. There will be the introduction possibly of a genuine living wage. So not only do we have minimum living wage, we will also have genuine living wage as well. Whether that replaces everything, we're not too sure, but it is just looking at probably, I'm guessing, enhancing what we currently have. And for those people that have post-termination restrictions in their employment contracts, for new people coming into the business, anybody that has non-competes will be reduced to 3 months. There's also going to be a big review into the parental and carers system and the leave and pay that currently surrounds that. So I expect some significant change. And over to Andrew Doyle, who hopefully has got a ray of sunshine to cast on the space at the moment.
Is everybody still with us? You know, if you need to go and get a coffee for 2 minutes or something. But I think it's important to acknowledge that a lot of the changes from finances and HR that have come about or are about to hit us come with quite an overhead to employment. Now, it might be that you are looking at how you can counteract that overhead. So what we've been focusing on in the systems team is developing a methodology around trying to boost employee productivity. And we've got a bit of a 4-step guide that we can guide you through. Obviously, I'm going to go through it from an overview basis here to try and increase the productivity of the team members that you've already got within your team to try and counteract some of the weight of employment of those people. So I'll dive straight into it, but it's also kind of important to recognise that the Prime Minister yesterday announced an initiative around AI. I'm still a little bit dubious about what benefits it's going to bring in the immediate term, but it's important to understand what it can and cannot do for your organisation. I don't think it's this magic bullet that we're all led to believe at this time, but over the next few years, it absolutely could be. So it's worth assessing within your organisation. So number one, within Fact 3, we use this methodology quite a lot as well. We form a squad of internal people that are really passionate about a particular subject. We get those people together and we say, right, okay, you guys go ahead and help us understand a little bit more around the subject matter. This one being the use of AI within your organization. And it may not even be AI, it may just be additional applications that you use and tools that you use within your organization that integrate into Teams. For example, when we were starting this webinar, we noticed that there was a Firefly AI note taker. I did remove that from the call, but we noticed that loads of people are using that Firefly AI note taker. I'll come on to the cautions around that in a second. But it's important to understand that we all need to be boosting productivity within the organization, and forming a little bit of a squad of people within your organization that are passionate about IT and techie stuff is step one of moving productivity forward. Step number 2, you need a little bit of guidance. The news around AI is all kind of positive, but there is some guidance and some cautions that we absolutely must give you. We've got some template guidance policies that we can provide to you to help you along that journey, but it's important for your team to understand, number one, the inputs that they should and should not be putting into AI tools. And AI tools could also be disguised and wrapped up into other tools that you use on a day-to-day basis. For example, one of our clients mentioned that Google Translate, a tool that you probably use quite a lot, Google Translate could actually be an AI tool. We don't know what Google does with the input that you put into Google Translate. They could be feeding that back into some kind of AI model. So if you're putting personally sensitive information into there or intellectual property information into there, we don't quite know yet what Google is doing with that and whether they're feeding that back into the model. Policy with guidance will help your team understand what they should and should not be putting into tools without the scrutiny behind selecting those tools first. And there are two classifications of tools, the ones that we do trust and ones that we're not trusting at this moment in time. And really the only one that we do trust at this moment in time is surprisingly from Microsoft. Microsoft Copilot. Microsoft have stated publicly that anything that you put into Copilot does not feed back into any publicly available AI model. So you can feel free to put as much information in there as you want. The downside of that is that the output that you get out of Copilot is not as good as the output that you get from some of the publicly available tools, such as ChatGPT. So you've got to really tread that fine balance. And when it comes to the outputs as well, you have to be very, very cautious about how you use them. Nothing replaces your professional judgment with the outputs of AI. So always be cautious. We have seen examples of when AI can be produce kind of very biased results. And when people say policies, a lot of people think about the guy on the left-hand side just issuing a Word document or a tick box exercise that said, yes, I read and understand it. However, we've got a Fact3 Academy led by Miles, part of Jane's team, who delivers training around policies such as the POSH training that we've all had to go through over the past few months in a very interactive and quite a humorous when appropriate way. Obviously get into the serious parts when we need to talk about the serious parts. But if you want to talk about a little bit more about how you can really embed the information that is within policies within your team in a much more structured way, then give us a shout about our Fact3 Academy service. Step number 3, embedding AI usage and best practice within your team. This comes with a number of different sub-steps as well. So you've got to understand what your team is currently using from an AI point of view. So what we suggest is have a little bit of an amnesty. Put a poll out there, bit of a form, bit of a questionnaire to the whole team and say, look, guys, we know you've probably used it. Nobody's going to get told off for using it in the past, but please do tell us, number 1, what tool you've been using, and number 2, what information you might have put in there, and number 3, how you may have used the output. That will allow you to understand if there's any risks that you need to mitigate or any points that you need to really address from maybe a leak of intellectual property or personal data. You may not have that, but it's always worth asking the question. Obviously, assess the results when people send them back to you. Again, amnesty is the word here to say, okay, let's put a hold on using that tool now until we can assess what impact that tool has or what it does with the information that you're pumping into it. When you've done that assessment, you need to have a look at which tools may actually benefit your organization, because some of them could be really useful. What we want to do is find a couple of them, and we'll come on to the next slide, about spreading the use of those tools in a very structured way with training, with controlled rollout across your organization. And that's when we come to this step. Implementing up to 3 suggestions. I don't suggest you do more than 3, and probably 3 is a little bit of a push for some organizations. 1 or 2 at least that may be really useful to you, that the team has said, yes, we have used this tool to do this task and it's brought this benefit. You find that information out about the amnesty kind of form that you put out there. You then go to the rest of the team and say, right, okay, we suggest that we're going to use this tool in earnest across the organization. And what we're going to do is fully change manage that tool into the organization, perform full training, and have a set of rules of engagement with that tool. And then following the use of that tool, after about 6 months, have a review Have you seen any impact from the use of that tool across your organization? If you do, great, continue using it. If you haven't, maybe it's something that you need to roll back on. So yeah. Then step number 4 for your squad is understanding how AI or other tools can impact and transform your industry. So once we've got all the basics covered from all the standardized tools that's out there, such as ChatGPT or Microsoft Copilot, what you want to look at is really industry specific applications for AI within your industry. I cannot really suggest what they could be because we're all in different industries, but your squad of people should have a much better handle on understanding what tools are out there. And the age-old adage as well comes into effect here, is that you don't really have to beat everybody with AI. All you need to be doing is beating your competitors with the use of AI. You just need to be a couple of steps further on than everybody else to really make significant changes that can make you stand out within your industry. That's where the uncharted territory comes in, is that is going to be some kind of mission for your AI squad to go out there and figure out what tools are out there for you. It's quite a unknown thing that they have to set in motion. So a recap of the 4 steps: form a squad, get a group of passionate people together, understand your current usage within your organization, embed good tools and good AI practice within your organization from the responses that you've found from your current usage forms. And then once all that is done, step number 4, how will AI impact your industry? I've just spotted a spelling mistake in that, apologies. Understand how AI will impact your industry. That's it from a systems point of view. As a roundup for this whole webinar, we've come up with a single line: fail to prepare, prepare to fail. So number 1, Andrew.
Yeah, number 1 is know your numbers. Obviously, the changes that are coming in, you know, national insurance and living wage rates are a burden to employers. It means that you will be paying more for your employees, and this will impact some businesses more than others. You know, things like the service industry will get hit harder due to its nature. There's a lot of concern around the leisure industry and how this could impact that industry. It's really important to identify the cost impacts of the changes. If you're a factory client of the numbers division, I would hope that, you know, the assessment of the costs has been undertaken and you're clear on the impact of this. I did note from the poll, you know, a third of you don't really know what that cost is. I would stress it's really important to understand this. We've got a simple online calculator tool that I think we're going to share that allow you to work that number out. Failing that or alongside that, reach out. We're more than happy to have a chat with you so you can understand that. Once you understand that number, it's important that you update your forecast for the changes so you can see what the impact is. I can't stress, you know, enough how important it is for a business to have a clear handle on its finances and an up-to-date forecast model in place. Ultimately, these costs are going to need to be recovered from elsewhere in the business, or they're going to have to be passed on. So either for your employees or to your customers for your products or services. Remember the earlier, you know, when I looked at the sort of cost that each salary band, you know, we looked at £40,000 salary is an extra £986 a year. It might not sound a huge amount of money, but that's 2.5% increase. Now, when you think about what you do with your pay and where inflation's at, all of a sudden it becomes quite significant.
Which then leads us on to what, you know, where do you prepare in terms of your people? I think what we can see is that 2024 has been a big year of change. We absolutely know that there's a lot more coming down the pipeline, but I feel like we've got a little window of opportunity to catch up before it all lands. Some of the dates are unknown for the changes in 2025. I would encourage you to sort of just take a breath, get familiar with what things have changed in the last 12 months that you might need to catch up on, in particularly POSH, and just contact us if you feel that you need any help with any of that. It is this time of year that people are starting to think about the new financial year. That tends to be the time that businesses are looking at pay increases. What additional benefits are we going to put through? This year, because of the NIC changes, it's a bit different. We can't just look at inflation and think, well, we'll just add that because that's what we'll do. I think there's going to need to be quite a degree of flexibility and creativity around this year's peer review considerations. I think once you get to grips with knowing your numbers, you then need to think about, well, contractually, what do I have to do with my people and pay rise? Most businesses say we do an annual pay review, but there's no commitment to an increase. This might be one of those years where, because you're soaking up the rest of the cost elsewhere, you actually need to think about other things that you can do that don't directly impact salaries. Things such as looking at your total rewards package. Is there a way that you can make disposable income go further for your people? Some good ideas are around group life assurance. That's quite a cost-effective product to plumb into your business, covers everybody, and you are adding to the total rewards package. Perkbox is another one. There are other platforms, but Perkbox is a reward and recognition platform that some of our clients are using. That allows employees to tap into things like discount codes, free money off X, Y, and Z. It just means that disposable income that may not increase this next 12 months or might increase less than what they would expect might be able to go further in terms of their lifestyle. Health plans such as dental, physio, optical, those day-to-day health issues, rather than private medical, it's more the day-to-day issues and costs. So things like that can give people expenses back, for example, in life and keeping themselves well. So there are some creative things that you can do by improving the package that you give to people, but without necessarily just doing the usual, it's X% worth of increase on everybody's salary, bearing in mind you're already going to have significant increases anyway.
And the third option as well is to increase a little bit of productivity within your organization to counteract the impact that point number 1 and point number 2 have by embracing AI, doing a little bit more training via our academy service, and a number of other initiatives. So please do get in contact if you would like some help and guidance around those areas from an IT point of view. So a repoll, beginning of the webinar, we asked a poll about how ready is your organization to tackle the upcoming finance and HR challenges is 2025. What I want to do is re-ask you that question to see whether your opinion has changed. So if you could answer that question for me now, please. Good to see that some of you are very prepared. Great. Just worth reiterating, Fact3 handle a lot of these issues on behalf of our clients and sort and prepare our clients for the necessary changes. And of course, the fundamental service that Fact3 offer is outsourcing. If you're looking at avoiding employing additional people in areas of finance, HR, and IT, absolutely come and speak to us about how we could plug in certain areas of our service into your existing teams to alleviate some of those employment costs. But we're always here to help and answer any questions, so please do drop us a line. We're available at hello@fact3.co.uk. And yeah, keep an eye out on our LinkedIn profile as well. Please do like and thumbs up our social posts. We're much grateful. Very grateful for any kind of exposure that we can get for this. We've got a few minutes left over. We've finished a little bit early. So does anybody have any questions that they would like to drop into the chat to ask us while we're on here? I'm going to stop the presentation. Is there anything that you guys want to state, Jane, Laura, Andrew?
No, I think it's
No, not for me.
No, nothing from me either.
Cool.
I imagine everyone's just digesting it all.
There's a lot to take in there.
There's
There
a
is a
lot.
lot.
There's a lot to take in. I think it's just, you know, looking at that last poll, the majority, 62%, are somewhat prepared. So clearly it's been a useful tool, I guess, to understand maybe where some businesses' gaps are. So do just reach out. We'll happily spend some time with anybody that has got a question or just wants to explore what they need to do to get more prepared.
Definitely.
Okay.
Okay. No questions have come in. So with that, I think we'll close